I'm about to tell you something that every trading guru out there hopes you never figure out. Most trading courses are designed to keep you dependent. They sell you signals so you keep paying every month, or they teach you one specific strategy so when it stops working, you have to come back and buy the next thing. This is different. It's a complete picture. Everything you need to know to trade for yourself for the rest of your life without ever needing anyone else again. And honestly, it probably doesn't make business sense for me to sell this because once you have it, you might not need us anymore. But that's kind of the point. Let me tell you a story. A few years ago, something happened that changed everything. GameStop, AMC, the whole meme stock era. I watched an entire generation discover the stock market for the first time, and right behind them came a bunch of vultures. Suddenly, everyone with a social media account was a professional trader. Influencers who had never traded in their lives were selling courses. Telegram groups were popping up everywhere, charging monthly fees for alerts. Discord servers full of people copying trades from someone who got lucky once and called themselves an expert. And it worked for a while because the market only went up. Everyone looked like a genius, but none of them were really teaching anything, at least nothing real. And they were just riding a wave and taking your money all the way. People were sold a lie that you could just follow someone's picks, copy their trades, and get rich. That you didn't need to understand why things were happening, just what to do. And when the wave crashed, those Telegram groups, they all went quiet. And I started getting approached by other groups, big groups with hundreds of thousands of followers. They'd say, hey, can you send us your trades? We'll pay you. And quite frankly, for a while I did it. I let them outsource their entire service to me. Their members thought they were getting trades from the group's experts, but it was me the whole time. And I'm not proud of it, but it showed me something important. Most people selling trading education don't actually know how to trade. They know how to market. They know how to build an audience. But when it comes to actually making money in the markets, they're paying someone like me to do it for them. And that's when I realized the real problem isn't that good education doesn't exist. It's that most people can't tell the difference between real and fake. And by the time they figure it out, they've already spent thousands of dollars. So here's what I built, and I call it the apprenticeship. Think of it this way. Most programs out there teach you how to make one, call it a dish. Follow this recipe and you get this result. But the apprenticeship, this is culinary school. It's learning to become a chef who can create any dish that they want. By the time you finish, you won't have my system, you'll have your system built around your schedule, your strengths, your risk tolerance, and the kind of trading that actually fits your life. Here's what makes it different. It's complete. We start from the very beginning and take you all the way to trading professionally. Scalping, day trading, swing trading, investing, every style of trading, every asset class, stocks, options, futures, crypto, even Forex. If you can chart it, you can trade it. It's perspective. This is not theory. This isn't, well, it depends, or only in these situations. Every strategy we teach is like a doctor's prescription. Do this in this situation every time, because we've tested everything across all market conditions. We only teach what always works, and we teach it in the right order. Most people's trading foundations are crooked. They learn things out of order, picked up bad habits, have gaps they didn't even know existed, but we fix all that, brick by brick, in the exact sequence it needs to be learned. Here's what I see every single day. I open up our community and people are posting their wins. Not because I asked them to, not because I pay them, they're just excited. $20,000 in a day, $100,000 account built from basically nothing, 1,600% return on a single trade. And it's not just one person having a lucky week. It's hundreds of people consistently over years. When I trade, you see everything. Every entry, every exit, updated profit percent, nothing is hidden. And you can scroll back through years of this, 2025, 2024, 2023. The numbers don't change. Here's what over 1,500 trades look like. Win almost 80% of the time. When you win, you more than double your money. When you lose about a third. That's what's true. So 8 out of 10 trades, you're doubling up. The other 2, you're only giving back a small piece anyways. That math works. And that's the skill set that you're going to build. This isn't about hitting one lucky trade. This is about doing this over and over and over and over again. That is what we teach. So here's what you get when you join the apprenticeship. It's a complete curriculum. This is everything that you need. Financial freedom for anyone who wants it. The ability to know you have a real skill set, that you can go to the market and create opportunities whenever you want. That's what this is really about. If that resonates with you, you're ready to stop guessing, stop following signals, stop hoping, and actually learn how to do this for yourself. Then click the button below and let's get started. The door is open. Let's make sure that you never get left holding the bag again, because you'll never need anyone else. What's up? We made it. Audio check. Audio check. I think I'm good. Hello, everybody. Look at this. Oh, yeah. I like the team. The team did a good job on that. Oh, and my boys in the house. What is up, GM? Hello. Happy Monday. Almost happy Monday. It was looking a lot worse Sunday night or Sunday. That's for sure. That is for sure. You like this sweater? Yeah, this is new swag, dude. New swag. It's got like a little, this is like, we just did super chill kind of graphics. But I like it. First one. Pretty cool. Pretty cool. Anyways, good morning. Good morning. Yeah, the intro, that is, I don't know if we have a link if you're interested in it, come join us. It's all good. We love you. Yeah, that was it's called the apprenticeship. We've done masterminds in the past, but this is different. That was, we do have the opportunity, if you want to learn how to trade, to learn how to do this for yourself. I'm all about everybody being like self-sufficient, but let's get into this. So if you're new to the stream, welcome. Make sure you subscribe to the channel, give the video a like. Appreciate everybody. And share it out there on the interwebs. But yeah, if you're new to this, every Monday what we do here, as long as the market's open, is we kind of take a look at what happened, what's going on in the market, what do we have to look forward to or look out for in the week ahead, and what's the hell is going on. So let's get into it. This is my thumbnail. So oil prices surged 30% over the weekend. Didn't hold the whole thing, but I mean, crazy. And I've been harping to our group for a long time that it's, you know, for the next, to me, it's legit like 3 to 5 years more, that energy in general is everything. Whether it's geopolitical issues or whether it's data center buildouts, I don't really care. Like there's no scenario in my mind that energy is not literally everything. And I mean, this is just one more reason of how we're, you know, what's going on, right? It's unfortunate of this catalyst, but I don't think, you know, to be completely blunt, I think it's just like that AI hate article or whatever, the fearmonger AI article about, you know, how it's going to be all bad for a lot of these software companies. Quite frankly, when I look at this, it's just kind of like, this is just one more headline that kind of was just fuel on an existing fire. And yeah, I think now it's kind of, everything's catching up. We've been trying to do, if you look at even energy commodities like CVX, Exxon, whatever, ConocoPhillips, they're not up nearly as much. And we'll break it down again this week. But what I can tell you, the fast forward version is that in truth, the catch-up trade here is the commodity itself, oil, which when you think about it, just simply said, I think Chevron, Exxon, XOP, the whole sector is probably up about 50% already when the oil, the commodity is not I think it was negative before, or basically flat. So it's a hard trade if you're looking for a catch up in the oil stock specifically, but they'll probably catch up eventually after oil does its thing. So anyways, let's get on with it. I grabbed a couple headlines. I mean, they're all pretty much the same. Listen, Iran warning of $200 a barrel if oil strikes on its infrastructure. Don't stop. I mean, just looking at some basic stuff, I could see 150 personally, but who knows? Analysts, multiple analysts are talking about this now. Obviously, that it's basically at the highs. Does it stay at 150? That I think is the question. Analysts see Brent going to 150. Russia's Putin oil production linked to the Strait of Hormuz. Again, risk coming to a complete halt. It's not shut down, but complete halt as early as next month. I mean, this is crazy, right? Trump says no Iran ground mission, and I'm not sure who he was referring to. I just grabbed this headline. Trump says no Iran ground mission. That's what was important. He's not happy with the new leader. We'll see. And a good headline. I can look at this guy. I can see 150 at hoodie. Yep. Novo. There's the good news. Novo Nordisk and HIMS. HIMS at the absolute barrel, like bottom of the barrel. I think it was in the low teens for a bit. Last I looked, it was like 27 something. I mean, this legal issue has been looming for them for a long time. And so that's going to be out of the way. This thing is shorted to oblivion. I don't know what the current short float is, or short, how shorted HIMS is today, but I know it's probably one of the worst. And then now they don't have the legal issues. They're going to sell Ozempic on HIMS and HERS platforms, and Wegovy. So yeah, I mean, it's good news. At least it's not as bad as where we were. So this is basically the thing. Like, it's all about oil. I'll tell you what, if we do see sustained $100 prices in crude for a while, I mean, yeah, the market's going to have a conniption fit. You sold the entire position at 24. Hey, it was at 7. That's a good, in like a, overnight, boom, over the weekend. It's a huge bounce. This guy always commenting on my hair, man. I love it. And yeah, it was a good week. Everybody have a good weekend? I mean, as best you can, for sure. But yeah, let's take a look at some other stuff. I think within this geopolitical situation, it's tough. It's definitely tough. And I have some slides here from a market perspective for our retirement accounts. Well, how does it affect us? Before we even look at a chart, I'll just say things are heavy, right? Things are very, very heavy. Like, as in, they do not look good. And they haven't looked good for a while. We'll get into that. But, it was anybody in the webinar last Friday, we did this free webinar. So if anybody was there, oh, look, Senor Foley. I had a friend named Chris Foley. I don't know if that's your first name, but or if you're my friend, but you can be my friend now. But yeah, the Apprentice videos, oh, dude, they're hot. They're very good. But where was I going with this? It looks rough at the index level. If you're in the webinar, and where I was going with this, is that the market moves on what it really is. It's like this relationship between inflation and rates, or inflation and growth, if you will. And the focus of that ends up being on the Fed, right? And everybody thinks, oh, the Fed interest rates, this, that, and the other. What are they going to do? The truth of the matter is, in reality, the Fed can only control like the 2-year Treasury notes, doesn't control any other market. So like, if you're looking at TLT, the Fed doesn't really have anything to do with that. But That was your dad's name. Love it. But it's all about are we going to raise rates? Are we going to lower rates? I think coming into this year, the market technically had about 2 rate cuts priced in for the year, but there was still a lot of optimism around maybe potentially more cuts. It could happen, but I'm going to switch this slide, and what I saw on this is just out of control. So what this is, geez, if my mouse would stay still, stay, mousy. This is the CBOE FedWatch tool. So this is from Chicago Board of Exchange. This is literally what is priced in terms of how many rate cuts and where is the rate going to be, the Fed rate going to be at what point in time this year and next year. And the crazy part about this to me is that, like, you look at this is 2 weeks ago. So 2 weeks ago, I tried to align this as best I could. It's not really great. We didn't have a rate cut priced in until June. So 2 weeks ago, we thought we were getting a rate cut in June. Last week, all right, we pushed that out. We thought we'd get it in July. And this week, we're not talking about it until September. This is how fast the market moves. This is crazy, but not crazy. And it's all about this inflation. So if oil stays over $100 a barrel, what's that going to do to inflation? It's going to go up. And so if inflation goes up, can the Fed logically lower rates, drop rates? No. That's just going to make things a lot worse, because what do we know about, inflation? Well, if rates are lower and it's easier for corporations to get a hold of money or loans, people tend to spend more. And if they spend more, that right there is how inflation goes higher. That's it, the velocity of money. And that was all kind of in that webinar last week. So why Friday's non-farm payroll numbers is honestly, to me, the most important number of the month, every single month. It tells the market how many jobs were taken last month. So this is going to be important moving forward. We're going to get a lot of stuff this week, and we'll take a look at it here in a second. I think I have the right slide somewhere. But this move, not only that, but now we're not talking about a rate cut. So first of all, it's like we were definitely 1-2 cuts for this year. Still 1-2 cuts as of last week. Now we're like 1, and that's it. Because January is here. So now we're only pricing in 1 cut for the entire year this year, which is crazy. So that we kept pushing out. And from where the market started this year, the sentiment has shifted right here, right? And so any other hopium thoughts of potentially more than 2 rate cuts this year, I mean, they're definitely getting questioned. If you go long here, you have to assume that this is just wrong, and it very well could be, but this is what the market is pricing in today. It has nothing to do with opinion. It is fact, as in terms of this is what it is right here, right now. So from that perspective, can it get better? I mean, yeah, I think it could get better, but this is what I'm looking at. We're looking, you look at the fear and greed index. I think we're not even close to peak fear. We are in fear right now. VIX. Anybody know the new the high of the VIX this morning? The high of the VIX was 34 or something like that. 34 or something like that. And I think this ideal scenario, right, is oil dumps and indexes pumped. Then I can. Hey, I actually like this because, and then you can finally go long oil related stocks. So oil stocks are not a catch-up trade. That's the tough part. The only catch-up trade, or the one that technically would have made the most sense to me was going long oil itself, the commodity. But it has been moving so crazy. This thing was $70 the other week. We were like 130 overnight. Just insane. And which any ceasefire kind of announcement is gonna drop oil like 20% overnight. So, you know, it's a hard environment to actually trade in. But because of where we started this, I personally would agree to this. I personally still think that energy, no matter how I slice it, is everything. Because if I still believe in the AI, you know, build out and this generational data center build out, I still think that's true. I still think that like energy is going to be needed. Whether or not it's like overpriced at this moment, though, that's the question. But this is where we are. We are no longer pricing in 2 rate cuts for the year. That's what's happening. We are now pricing in 1 rate cut for this year. I don't know if I said cuts or hikes, but I meant cuts. But we're only pricing 1 cut in now. The one. Yeah, and this is the hardest part. The main play already happened. So crude, USO, 130 in the pre, you're pretty much there. This is kind of like it's very reminiscent of silver, and not gold, but silver. Like, you know, the silver trade, you saw it coming a long ways away. Is it over? I mean, it's holding, but for a period of time, it was way up there. So if we get these crazy spikes and oil settles around, I don't know, 75, I think that's probably realistic. But to come in on oil here now, that's crazy. I mean, not crazy, but like it's risky. It's not crazy. It's just risky. So it's a hard trading environment from that perspective. You know, one other thing I don't do very often is that there is this. If you Google this, is NAA. Just start NAAIM, and I'll just pop this here. There's a survey, and this survey is essentially what is the actual exposure for like to equities for I think this is not retail. This is everybody. But we're last quarter, we closed at 92. This does go over 100, by the way. And I think the last couple of weeks, we were in the mid 80s, mid to high 80s. Now we're sub 80. I will tell you that this index actually goes really low. I've seen it in the teens. I think it typically bottoms below 60. But we're not quite there yet. And on the website, it's kind of cool because here's the national exposure, and then they have down here's the actual S&P 500. So the exposure's going down, but right now, I mean, the S&P 500 is still going sideways. So all of these things together, you're like, ay, there's some crazy stuff. Plus, I'm not being a fear mongol. I'm just saying this is where we are. Plus, we have seasonality to deal with. So I'm like, we got this, we got that, we got seasonality, headwinds. Technically, March is okay, right? But from a four-year cycle, right? Presidential cycle, 1, 2, 3, 4. I mean, we still have a little downside to go, but this September dip is the dip to buy. So it's like, I want to buy stuff. Like, I really want to buy stuff. But at the same time, I'm like, we could have a lot more downside in the cards. So I still need to have cash at the ready. I think, in general, I still want to have cash at the ready. And again, if you're buying anything, I said this last week, if you're buying anything with at least a 3-year time horizon on a 4-year presidential cycle, this is the dip to buy, right? Or really, I mean, anything in this area from here, because it is, it's 1, 2, 3-year time horizon. I mean, I still have the biggest, strongest rallies to come from that cycle perspective. But this little dip, seasonality has been a little weird, but generally speaking, everybody that's a major player in the stock market and has been around for a while knows this cycle. This is not a new thing. So yeah, we can have a little bit more downside, but it's going to be a buyable dip, probably towards the end of Q3, early Q4. But, if I'm trading on a calendar, that's how it usually plays out after tax, after everybody's extensions are played. Also, this kind of like revolves around the tax season because a lot of people are probably about to pay massive tax bills as it is. So we might see a little bit of pullback. And the difference, quite frankly, between a midterm election year and the rest of the years is that we will typically get like a June, July rally in the middle of summer. And for a midterm cycle year, we don't tend to see that. That's usually the main difference. So yeah, it's tough going. I think, certain things, the good news here is that certain things bottom way before other things. Like I talked about Trade Desk the other day. Oh, that's crazy snipe. Trade Desk off the lows, HIMS off the lows. Hopefully my Robinhood, I don't know, but certain high beta stocks, a little bit more dangerous, but they will bottom first. So I tend to watch those things, right? And the large cap safe stocks are usually, honestly, the last ones to fall out. So like we can watch Google, right? Like Google's really strong still. Last I checked, hopefully I don't have to take that back, but yeah, not down a lot in the pre-market, but still over, I think is over 300. I don't know. We'll take a look at the charts in a little bit. But yeah, I think certain things to me are okay to bottom fish. Sometimes it's sometimes but it's got to be really bad. Like 50% is bad, but it's not like, oh my goodness, bad. So I think that's kind of where I'm at. Like it's got to be, and also it's got to be a good company. It can't be like C3 AI. No offense for any C3 AI holders. I just don't think that that's going to be like the best stock on my shopping list by any means. But yeah, I want to have cash available. I think it's important to have cash available. And if you don't, how are you going to buy the dip? How are you going to buy the dip? That's my biggest question. How would you buy the dip? But anyways, let's move on. So this week, we have a lot of data coming. If you didn't know, Friday, we got our non-farm payrolls report. That's going to, for me, and my data backs this statistic that roughly 90% of the time, the non-farm payroll release marks the higher the low for the month within about a 1% margin of error. That's a hard statistic. And it's not like, it's massive. So I want to go back to last week's chart, and we want to just kind of simply stated mark the high and the low of Friday, because that's either going to be the high or the low for the month. It's pretty clear to me already without looking at a chart that we opened up red. And right now the question is really, was that the high for the month of March? My gut says it was so far. But this is the trend. Will that, if that's true, again, 90% probability of being true within a 1% margin of error. If that's true, then that will develop a trend across the market and kind of ripple down throughout sectors. So you got to be patient. You got to see how this goes. But we have some more data coming this week, and the data is not small. Like, so this Wednesday, we get CPI, which is also inflation. This is the market's favorite economic indicator. It's not mine. But it's the market's favorite because of that relationship between inflation and growth, GDP being growth. I also believe we get a GDP revision or another GDP number. But yeah, so think about it this way. If we have high or sticky inflation and the economy as a whole is not growing as much as we hoped or not growing at all, which will show up in the form of GDP, that's rough. And so that's the fear. So that fear is underlined and we see the rest of it. And it seems to be, people with that fear will say, oh, $100 barrel oil, that's going to be justified fear now. That's where we are. So yeah, I want cash available for the dip. Again, not being a fear monger or anything, but if this dip is good, like if it's a good dip, like if it's a money dip, which I think it will be, I hope. I mean, I quietly hope to myself that it's going to be a very hefty, beautiful, beautiful dip to buy, because you bet your ass I'm buying, but not yet. Not yet. Yeah, those who were paying attention last Friday absolutely know it. Absolutely know it. So CPI is going to come out on Wednesday. Is it going to reflect $100 barrel oil? No. Is it going to reflect higher oil prices? Yes, for sure. And then and the market's going to react on that, because then they're going to see, sticky inflation, most likely, and lower GDP, which is, I think, what we're seeing the market kind of front run a little bit. And that is not, in that scenario, that is I think that's stagflationary scenario, in which case, commodities themselves are like the main trade in the market, meaning silver, gold, oil, commodities, any dollar denominated asset, copper. We could talk about copper. I think these assets, these commodities are a crazy trade right now, but a lot of them have run quite a bit. So it's very hard to get behind them again. And if you haven't, I don't think you need to chase them. But I would say, hey, look, if we get dips, these dips are going to be money dips as long as you have a long enough time horizon. So that happens on Wednesday. And then we get Friday, which is this is the number that the market looks at, right? CPI. That's on Wednesday. That's not really the number that the Fed looks at. The number that the Fed looks at is really PCE, and that comes out on Friday. So PCE stands for personal consumption expenditures. And so earlier on in the video, Friday's webinar, we talked about how is inflation, this is inflation, really determined. It's really determined by the velocity of money, and that shows up in PCE. So again, the Friday number is actually a little bit more important, because that is how much, this is the old inflation reading. That's what this is, CPI, Consumer Price Index. That's what has been in terms of inflation. And a forward-looking component of that is this PCE, which is how much are the consumers spending, i.e. the velocity of money. And if they're still having to spend more, not necessarily talking about getting more things for spending more money, we're just talking about spending more money. If there's a difference there. If they just have to spend more, that's going to imply that CPI will either continue to be sticky or elevated. And so it's a big week, man. It's a big week. I checked on the earnings front. There's not a whole lot. I think the other, like this Adobe that's been absolutely decimated. We got Dollar Gen here on Thursday. So Thursday before the open, Dollar Gen, interesting one we'll see. Tomorrow after the close, I don't know if this is patient zero or what. Would you guys consider Oracle patient zero? I don't know. Patient zero Oracle, potentially. This thing was way high. I don't know. I think this is at risk to me. Definitely. NEO, I don't think is going to have much to do with anything. Some biotechs. HPE, actually, so tonight HPE might be interesting because this is Hewlett-Packard's enterprise version. So this is servers, storage, and things like that. Direct competition to Dell, Supermicro. I don't know that they're going to do that well, but it is what that is. And yeah, so we'll see. Ulta, the lipstick stocks, it's been doing all right. We'll see. Not a lot on deck, but yes, CPI, 10-year. Then we have a 10-year auction too. Holy crap, 10-year auction. Is this right? This says PPI, March 8th. It's got it right. I must have missed PPI. I put PC here. Put PC for here. Maybe their earnings calendar's off. We'll take a look. But I think before that, we have to check in with one of our friends. And if you're not familiar with this, what I'm going to do, I'm going to check in with a good friend. Her name is Miss Cleo. Sometimes things get a little kludgy in the market. We jokingly call this the T in TA. Some of the crew love it. Some hate it. I would tell you it's for comedic relief because sometimes we need a little breather. But yeah, let's see what she has to say. If you're not into this, look away for a little bit. I'm just gonna read this thing and then we'll jump back into some tickers and stuff. But go ahead and take a look at go ahead and drop your tickers and then let's take a look at what she had to say this week. All right, this is the deal. So we get a forecast from our, this is the T in TA, because, if you're going to joke about technical analysis being astrology for men, we might as well show you what you're comparing it to, because this is legitimate astrology. But anyways, we get a theme card for the week up here. I don't know how well this doesn't look good on the onset. What is this? The 6 of Swords. I mean, it looks like we're being ushered away. We look a little sad. I don't know who's celebrating. And then we get these daily cards down here. Each card represents a day of the week. I don't know who's celebrating today. This card, I mean, maybe the Bears or anybody that was long oil, but it was kind of short-lived. Yeah. This looks like a happy card. I think she probably got it wrong. I feel like actually the day is not over yet, so we'll have to see. This is a 9 of Pentacles. That's usually, that's very yellow. I just see a lot of yellow, a lot of gold, so maybe it's a long gold day. I don't know. No idea what the world means. I think this is I don't know. There's a little black cat on there. What is that? That cat looks wild, dude. What's up with that? I feel like Miss Cleo should get a new deck. That cat looks ominous. And then the Tower, which I know this card. This is a weird card. So it's like either we go up just to get smacked down, or we've already gone up and we're about to get smacked down. One of the two. Yeah, this cat's kind of bugging me out. I don't know, but let's see what she has to say. So the theme card is the 6 of Swords. We go 9. I guess last week was a 9. That's what she's saying. Looks like a reversal of some sort. The fact that this is a transition card furthers that connection. Well, we're transitioning for sure. I'm looking for a few days of mean reversion, but it may take a day or two in order to manifest. A possible pattern is red Monday and Tuesday that leads to a trend back up through Friday. We'll see. Monday is the 3 of Cups. The card pictures 3 sisters. I couldn't tell that they were boys or girls celebrating a positive event. I don't know. Unfortunately, they're too busy drinking to pay attention to their finances. Sounds that I feel like that tracks. This can signal a laissez-faire attitude from which weakness follows. All right. However, when it does trend, it trends green. So don't fall in love with the bias until direction is clear. Well, I mean, open, down, rally up for the day. that makes sense. So maybe she got it. Maybe she got it. I don't know. Tuesday, 9 of Pentacles. 3 to 9 brings us the series I mentioned in evaluating the theme card. Look for a final push in Monday's direction. Well, which way is that? This can be green, okay, or red, and is unlikely to trend. Chop is the most likely scenario. You're not really helping me here, Miss Cleo. The world for Wednesday. This symbolizes completion of goals and the hope that follows. In the current environment, and drawn on a Wednesday, it can lead to a pivot that gives the trend day we've been hoping for. Is this CPI? I think it is CPI. Look for a close within 0.5 to 1% of the open with a 75% chance of green. Is it just me here? Is this a huge range? 0.5 to 1% from the open? I feel like that's a lot of percents for a single day. It usually mean reverts when following a minor. So if Monday and Tuesday happen to be red, then it's game on. Game on what? Game on green? Either way, chase momentum. I think Miss Cleo is a day trader, by the way. So I think I've figured that out. Thursday, Queen of Wands. The Queen sits on the left hand of the King. What does that even have to do with anything? With nearly equal energy and impulsivity. The last time she followed the world was a double green day. Queen tends to be more protective than their male counterparts. Queens tend to be more protective than their male counterparts. So downside should be protected. I guess the negative chop is the worst case scenario, but she doesn't know. So Friday's the Tower. The Tower is one of the most energetic cards in the deck. It brings collapse after a strong run and reversal after a strong run. Well, collapse after a strong bull run, reversal after bear run. In either case, the green gets faded, sometimes fully, before any real rally can take place. So we're looking to sell rallies, but only for a quick turn. We buy dips until the rally manifests. Okay, that shit right there we don't do. But okay, Miss Cleo, you can do whatever you want. Recap, this is a cleaner week than most. There's a lot of energy, and we should see more trend days than chop days. Well, that's the good news from Miss Cleo. I think that's it. So with that said, I'm gonna do one more thing. I have for a while, jumped over to my buddy Evan's post. If you don't have this, I'll just pop this every Sunday. Every Sunday, he puts a little catalyst watch out. So I'll just drop this. This is what I'm looking at. Dropped in the chat. Collapsing towers. No. I don't know, guys. I don't know. But what I want to do is I want to just drop over here, check in with our boy, and see what the catalysts are on deck for this week. Because I think there's a couple coming up. This is a pretty brutal image he's got going on. CPI. We talked about this earlier. I did want to check. Do I have PPI? No. So I don't see PPI anywhere here. So probably Earnings Hub had that wrong. But today, yeah, so we get existing home sales. This is really a nothing burger today. This core inflation rate month over month, this is the important piece. So this is CPI here. And what it says, it's going to come, you're going to get a headline. It's going to be called CPI. There's going to be a month over month, and there's going to be a year over year number. There's going to have separation between inflation rate for the month and for the year. What's important is to look at the forecast, right? And so the forecast, consensus. Consensus is what's priced into the market today. And so right now, the consensus is that we have a 0.2% up core inflation rate month over month, and that lands us at about 2.5 for the year. That's what the consensus is. Now, that means that this is what the current market is priced for. If this comes in at 0.4, I would expect some serious downside shenanigans. If it comes in, say maybe 0.1, then we could potentially rally for time for a month over month. And then if we do come in at 0.1, I think maybe the year over year ends up being at like 2.4 or something like that instead. And same thing goes for inflation rate. So you have 0.2 consensus. This is what is priced into the market. If you come in at like a 0.4, it's probably going to be all bad. If you come in at a 0.1, it's probably good for the market. So good news is good news. Bad news is bad news from a CPI perspective. And that kind of takes us to Nothing Burger went Thursday, but really, yeah, here we go. So GDP, we get a new estimate. So this is the second estimate for Q4 GDP in terms of what was Q4's GDP or growth rate. Consensus is at 1.4. That's a lot lower than I think I was expecting to see. So that's kind of interesting. If we come in at like 2.5, that actually might be good, because the consensus is here. So good news is good news again. And then PCE, these might offset each other for the month of January. Since this is Q4, this is going to be January here. These might offset each other. So like even if this comes in good and PCE comes in at, I don't know, 1 or 0.8 or substantially higher than 0.4 in terms of what consumers are spending in January, that's going to offset any good news that we had for GDP. But again, GDP, this is an estimate, second estimate number. It's not a final number. Yeah, that's where we are. GDP price index, JOLT's not going to be a big deal. I don't think consumer sentiment's going to make a big, wave or anything, but it's going to be these two things. So between GDP and PCE for Friday and CPI tomorrow, Wednesday, these are the two big market movers for the week that we have to watch out for. In terms of catalyst watch, let's see. Earnings, we already know. Dividend watch, Google has a dividend with the G. FedEx, Travelers, dude, that thing's probably going to be rough. IPO lockup. Anybody own Klarna here? IPO lockup for certain blocks of Klarna. This has not been a good performing stock. This stock has been not good, but this lockup expires today. I guess we could take a look at that. Deutsche Bank, Event, Telecom, Roku, actually been holding up. And then NVIDIA, Apple, what is this? Game Developers Conference, probably not a big deal. Shareholder meeting, nope. Blackstone. We'll see. Tuesday. Don't know these guys. Barclays Healthcare Conference. J&J, Baxter, Medline. I mean, this chart has been, I think J&J's pulled back a little bit, maybe something to look at. And then the next summit for online gambling will start. I feel like we just had a online gaming conference, but we'll see. Wednesday, this is, UiPath apparently releases Campbell's Soup. Does anybody remember when Fossil was like a short squeeze candidate? Fossil, like the watch. I have no idea what that thing's doing. And then my Celsius, Jared Lagans, will present at UBS Global Consumer Retail Conference. All right. Thursday, my Ulta. Lucid has an investor day. Long-term growth map. I don't know. We'll see. Lucid's probably like the furthest behind in terms of like self-driving stuff. Eli Lilly has an event. So we have some biotech stuff coming up. EPAM, Mattel. Yeah, I don't think this is gonna be a big thing. PCE. And that's it. So I don't see anything major. I think we have GTC coming not this week, but the week after, which is a big catalyst for NVIDIA. We looked at earnings. Is there anything I missed? I mean, Campbell Soup, I guess, UiPath. And that's it. So that's what we got on deck right now. This is that Fed thing. This is crazy. When I compare this FedWatch tool, I can only look at this current one. I can't look for the rest. But yeah, we were at 17% in February that we might have a cut, and it's just gotten closer and closer to nothing. Nothingness. And you click on this probabilities, and that's where this gets you. Only one cut this year now. That's crazy. This is the NAAIM Exposure survey, or not survey. It's not a survey. It's like actual check. Yeah, so that's where we are. So I'm going to take a look at the indices really quick, and let's go ahead and get into this. My first look is usually using like a 30-minute chart, like so. See where we are. I have a couple things I'll monitor at the bottom right now just to kind of give me broader kind of like checkpoints and really see where we are. But here's the S&P 500. So right now we know that this was resistance, generally speaking. We know that this was support, generally speaking. We are potentially going to find out if we have a classic SR flip, meaning what was support becomes resistance down here. To me, a breach of this probably could have been viable near term. and we'll see. But the biggest thing, and I'm going to turn this on really quick. I'm just going to do one. Is this line, right? So this is Friday's trade. I'm just going to make this a little bit bigger. Let's go. Huge. This is our indicator. And let me change a couple settings so you guys can see the numbers a little bit better. I don't have it this big normally, but this is just for you. I'm going to make this full. All right. So this is the S&P 500. This is Friday's high and Friday's low. This is a 30-minute chart. Typically what I do, we had a little bit of a gap down. I'm going to take this down because it's a little distracting, these little boxes. We had a little bit of a gap down over the weekend. We have since filled that gap. We'll call it right here. And I have a small itty-bitty tiny 30-minute candle that says we're kind of stalling. So we shall see. The question remains, was this the high or was this the low? TBD. So what I'm looking for is like, I'm looking for a couple days, 2 to 3 days really, to see a full trade open below and close below 669.77. And if I can get that, let's say we close here today. If we close here, then I will get that one day. Honestly, I should expect that this is the high for the whole month. If you're selling options or selling premiums, things like that, I think that, selling anything in this area is probably good for now. But we want to know where the next target is. So to do that, I need to find out what the other levels are. So, interestingly, this is an October NFP level. So even more interestingly, 661.20 was a November level. So what I'm going to need is for November, which is this right here, if I have an open below and close below here, then I do know that we're going to go to 652s and potentially 643s. That's the level below. That's actually what's going to matter right now. And then 600s for August. If we continue on that trajectory. So far, all I can tell you is that 652, it's probably within a week's average week's range. And 675, we go here. It's not unless we have a full day's trade. Like if we're completely trading above Friday's high, 675 or 678 and the rest. Let me just do this. Then in this instance here, I'd say, okay, if we are fully opening and closing above 678.58, then we'll be going up in here and probably retesting resistance up to that area. But until then, we're not even close to that. It's possible, but those are your targets for the month. What I do want to do is I kind of want to see like what is the average week's range. Usually something I'll do out of the gate. Let's see if I can get this update. Here it is. So an average week's range, I have this automated on my screen, is this full range right here. So to the upside, an average week's range could actually take the S&P 500 from the open up to 680, just under 680, which would probably be retesting a lower level of resistance and Friday's high. To the downside from the open, looks like this would be just below the 200-day SMA, and I think that was actually one of those NFP targets. Let me just do this. We got to go to September. Yeah, puts it at 650s, just around the 650 area for an average week's range, which kind of sounds wild, but it is what it is. So anyways, this is where we have it. And if you're wondering how this worked in the past, this is last month. This is February. It was in fact the high for the month. It right over here. This is pretty much always going to happen. We got a little bit close. We tested it once, but ultimately the low of the month was locking in here as new resistance, and we actually got to some targets. So that's SPY. Yeah, again, we're nowhere close to my my famed death cross buy signal. Like nowhere close to that. We were just barely below the 20 and the 50-day SMA. So, I mean, realistically, even if we did get a bounce, I just am not a buyer here. I think this is like this looks sketchy. Qs, a little bit worse. We are very close to Friday's high. We're actually within range again. So here we go. We've opened below. If we close above, here's how this works. If we close above Friday's lows in general, what this system tells you, and if we open above here, is that we should see 605 very quickly within short order, within maybe even that same day, if something like that happens, and you'll get a little move just like this. So that becomes a very tradable range. My issue here is that the upside is like 607s. I don't really like that. And if I remember correctly, I think that we have even bigger targets on the Qs right now. Yeah. So if we stay below this 598 area, the next level is 581. So right now, if I have open below and a close below, we should see 581, 580s, like in very short order. And that's probably going to be the downside targets for now, because in order to think that we're going to go even lower, I still need to have another open below, close below 581 again. Then we go to here. Then I need to see it again in order to go here. But that's the trajectory. So there's a bigger downside move available on the Qs. Upside, there's just a ton of traffic up here. So this is tough, right? So there's just a ton of resistance. That's about the 20-day SMA. What's now going to be resistance it wasn't even support. Like it was resistance almost all of last week, I'm pretty sure. So I'm going to take this back and put this number back to something more manageable. But that is also, look at that. That is also Friday's last month's low. So that's last month's NFP low. There it is. There's my within 1% of error, margin of error right there. But this thing, if we can't get over 608, there's just like no shot here. So more patient and way more cautious on the Qs than anything else. I'm not liking this chart setup, man. From an average weeks range, let me go ahead and pull that up and see what that puts us at. That is a bit rough. These are near term, but from an average weeks range, that gives us up to, up to 612. So we could get up there possibly here. And then on the downside, we actually have down to 575, which is that a target? I don't know. Let's see. 581 is not five. Yeah, right in this box here is that downside target. And that is within an average week's range. So that's what it is at the moment. If I zoom out a little bit, I don't know that it makes much difference. We'll just pull this on a daily, but yeah, we're bouncing. Maybe we get a little pop back up into resistance, but not looking good, guys. This is the volume profile for the Qs. Wow. Yeah, that is a lot of resistance. I didn't realize there was that much resistance here for the Qs around that 600 level. We must have been there for a long time. 167 days so far. The Qs have traded at this level. That's like nothing. And if I zoom out, really? That's a massive gap. I didn't realize it was just that obvious. That gap to here. Let me just hang on. Yeah, and then that'd be my downside target for the year. As close to 500 as you can on QQQ. That's the September doldrums. But the good news would be what? That if we did that, we would probably be 590s by year end. And then that would set up for then over 700s in Qs. Maybe year end, maybe early Q1 or 2 of next year. So if I can get buys in this area as close to 500 as I can for the year and look for a setup something like this out, that's super typical. But this is very, very long-term. So for my long-term investing friends, that's actually where I'm at. This SPY is actually kind of similar. This is not looking good. It's about 600 on SPY. We are below primary support, but it's about 600, maybe a little bit lower, below 600. And if we did get something like that, that would set up for the 750s to 800s next year. What is that? If I got something like this to the 800s next year, I could get another 40% if I'm patient on SPY. I like that. I like that. Some of you guys that don't know me, like, it might be like, oh, this is crazy logic. This stuff plays out way more often than you would think. 2 other index like ETFs that I've been watching for a while. One is IGV to tell us if we're going to get a bounce. We got a bounce in the software sector, the most beaten down name. To me, this could go all the way up as high as like 100 and still be in a counter trend bounce. So you got to be very careful about that. 97. We're barely there. So at this rate, even if we had a pullback or stabilization and got to here, I would be very cautious of some kind of price action that looks a little bit like that. But this counter trend potential rally has been on the cards for a while, and I've been very explicit in my words to use, like this is counter trend right now. But I think, again, if a sector is going to bottom first, it's going to be in this area. Is this enough to pull up the rest? I don't know. And the one saving grace that has been in the market was this RSP, or equal weighted S&P 500 index, which has decidedly broken trend. Right now, it was very close before. And so between these two things, this is what's tough for me, right? Is that because, IGV looks like it could get a little bit of a bounce. If IGV's bounce is not strong enough to make up for the equal weighted S&P 500 pulling back this strongly and this aggressively, it's at least going to be choppy at the index level for a while. But if IGV all of a sudden doesn't hold on to some of these gains, and this is still continuing to happen, that combination is what gives us that pullback at the broader index level. So these two charts, super important. Let's say if IGV is still strong and RSP recovers, that combination, both of these two things going up, that combination leads us to all-time highs. But that's not what I'm seeing right now. And I think because of that, these are the most important charts, not Nvidia, not oil, not Bitcoin, not any of that. I think the combination of these, not the VIX, not the dollar, right now, this is what's going to tell me from a broad perspective, what am I really walking into? The dollar, by the way, pretty stable, about 100, coming off a pretty bad year. It is what it is. But if this starts to recover or bounces a little bit, that's probably keeps gold, silver, copper, speaking of, a little bit at bay, breathing. But again, copper here, this is not coming down. The ones that I was talking about earlier, this is XOP. This is the oil and gas sector. And if you haven't seen me put this chart comparison up, I'll do it right now because I think it's important to understand, well, that even though we might be seeing oil at all these crazy rallies, you look at XOP and you're like, why is this not the ETF that tracks all the oil stocks? Why is this not doing the same thing? Well, when I put it on, let's say, a weekly scale here, and if I were to compare something like US oil or you know what, let's just do crude. Can I do crude? Maybe I can't do crude. Oh, this has gotten all this guy, regular. It's oil that is still the catch-up trade, oil being the orange bar, right? So at the lows, I need to go into daily. This is 2025. At the lows here, we are up 65% for the assets, and oil right here is basically flat. And at 100 a barrel, I mean, it's up 11% on the year. So, I mean, just inflation alone, because of that, I'm like, oh crap, these guys, the oil stocks have come up quite a bit. They never really pulled back while oil was dipping. They held pretty steady. And now this thing is just catching up. And again, just from an inflation perspective, I'm like, wow, it's hard to just not acknowledge that oil itself as an asset is regardless of what's going on. Like, you know, Trump might not want to keep oil at this level, but he can't stop in the short term, like what's going on geopolitically. Do I really think? What do you think? I mean, I do. I really, really think that. But for all the reasons that I listed, can I be wrong? I could easily be wrong. It would just take one headline or one narrative shift to change. But right now, I'm not wrong. So we shall see. ServiceNow is up 70%. Let's take a look. So I'm getting into this. So that's not true. Oh, your calls are up? Yeah, that doesn't matter. Good for you. But exit stage left, my friend. You're at resistance. Yeah. Go in all in Rocket Lab. All right, well, let's look at Rocket Lab. Let's look at ASTS. So I think, I like Rocket Lab. It's holding. I like this pullback, but again, I need the narrative. This is a harder one because it's like I'm not going to see the headline coming, which is going to be the catalyst for the narrative to be in focus for Rocket Lab. So you would kind of have to speculate a little bit. But right here, right now is just okay. This is your average basic run of the mill 50% retracement from this low to this high. That's exactly what this is. It's not anything special. It's not a huge edge. A better edge was 60, but can it go to 60 again? It really can. I just don't want to see it lose this area. So this year, this is your support on Rocket Lab right in this area. Let me turn my volume profile and some other things on. And you're underneath this. You got a lot of headwinds right now. All this needs is like a little headline, but that to me, that's guessing. So I don't really do that game a whole lot unless, at least not with real dollars, like large dollars. I could see this up to 85s, at which point you got to chill because it's going to go sideways for a bit and it may take that trek back down or it may go back to the upside. But the trade that's available is from here to here. It's still on deck, but again, it's very high beta, very high risk kind of trade. It's there. And if not, if we can't hold this area in short order, it would be back to 60s. And if you lose 60, it's just, you really don't want anything to do with this because you want to get out of the way if it loses 60s. Because you'll see 40s real fast again, which, maybe you like to buy it there. But if you like it, I would say this is your first buy zone. This is your second. So 1, 2, maybe it gives you an average of 50. And that would be it. If I got a crazy annual drawdown on something like a Rocket Lab in the 40s, I think I would take it. But it means you can't be over leveraged at the wrong time. And this might be the wrong time to be able to do something like that. ASTS, a little bit more challenged, doing something similar. We'll take a look. Yeah, so this is your support area. Again, right in here. This really needs to hold. I don't know about this. Right into that bear zone of resistance. ASTS already did what I kind of just outlined on Rocket Lab. So right now it needs to hold this like under 80, low 80 level. So maybe it goes sideways. This is already reported earnings, but we shall see. Thank you, Connie. Yeah, if you haven't smashed the like button, do it. I'm going to get into some requests here. Vlad wants Nokia. So we'll take a look at Nokia. It's been on a little bit of a bounce. I don't know. It's not my kind of stock, but what I would say is you have a pretty kind of clear measurement. Don't trade options with something like this. This is strictly equity. And what I would say is we need this. I'm going to do a couple measurements here. Roughly $7 is going to be your support. This is extremely high beta. And if you get this, cool, you can see something up to there. So, this area, it's coming into support, 20-day simple. It's not really going to be a big thing. If you lose that 20-day, you're going to the 50, which brings me to that 7 here. But when you zoom out on this, I think that you're at even a bigger resistance area here. Yeah, so this is usually 1, 2. This is usually 1, 2. The third attempt on something like this does not usually end well. I don't know that I would consider this the third. We'll see. But if this was the third attempt, that's not ending well. Yeah, if it's significantly over 9, okay, cool. But all this noise in between now and then, I think, have at it. 43 billion. I think Nokia is now network stuff. Yeah, I mean their whole network infrastructure, their whole business model has changed from the old Nokia of old. I just can't really speak to this at all. Yeah, the indicator's gone through a couple revisions. It's getting updated, so you or I could update my NFP indicator, and it will look different. But yeah, check. I think Ryan's doing a bunch of updates. Why does the dip keep getting bought up? It's really annoying that it patiently waits. Yeah, it's because of what's going on. Like when we look at what's happening from a war perspective, dude, it's usually like a week or so, I think, historically, of just like kind of fear mongering kind of stuff. Look, this is something that if it does pull back, it's not going to happen overnight. It's not a short-term thing. This would be a longer, drawn-out situation. I don't know what the headline's going to be, but it could be. It's going to be multiple things stacked on top of each other. Until then, the dip's getting bought because you know what? Go back to last week and the week before. Earnings are really good. Like it's wild that in the midst of all this, here I'll just do this. This was last week's earnings, the end of the quarter. That this is probably my best earnings collective on record. 28 beats, 2 misses. So it's tough because you still have a lot of optimism. Earnings are not breaking down. So there's still reasons for people to be somewhat bullish. Yeah, guys, get up. This is all getting updated. And on the NFP script, if you have that, it's all updated. You don't want to be on the daily. So I believe if you don't have the correct numbers, October, and if that's when the actual release came, and then we have ADP. So when the government shut down, there are ADP levels. The market uses ADP instead. So that's all in our indicator. That's literally baked into all of it. But look, right now, we're probably going to close below. Telling you guys where we're going, November. This is November 20th, not the first Friday. It's because it's not always the first Friday of the month. It's the day that the data gets released. So if you try to script this, have at it, but you're going to have a lot of errors. I know that our team after this last version of this has been, I don't know, 80 hours maybe, just going back and checking the last 10 years of data to make sure it's all good. But let's take a look at some things like this. So SMH. And you go forward. SMH Friday's high. Yeah, same thing. Open below. It's like I have an open below. If I have a close below, cool. Like this is an equity ETF. It's not the index. NFP was designed for the index, but it works pretty close, man. Here's last February. It's not going to give you the exact same metrics because again, this is more than 1%, but the 1% is designed that's QQQ SPY. But it's pretty close. Plus we have GTC coming next week. So the broader semi index, I think you have to look at something like a Broadcom, which is now actually at resistance. It did good on earnings, but what I'm not seeing, here's earnings for Broadcom. When we do this kind of stuff, I'm looking for can it actually sustain a move over that high? Well, it's trying. it's not like getting up and going, and overnight markets are selling this off in between. So I'm not super bullish on Broadcom even after that earnings report. What I will tell you is that this is like a bearish retracement right here, right now. I don't like it. I actually don't like it. So I would rather NVIDIA with the catalyst coming from a short-term perspective. Long-term perspective, yeah, this is a kind of a chart that could one day can change the whole trajectory of this situation on something like a Broadcom. I know this wasn't the request, but SMH was. I think this is a massive part of it. One day it could be like this, and then boom, and then boom. So this is not a chart to jump into. I defer to leaning short on this maybe later. Around like 360s, if I saw that. This is a rough one. But so far, it's holding up like NVIDIA. So maybe it has that little piece of it. Merck. We can look at Merck. So Merck is fine. I think biotechs are hard in general. Just because you have to know like their pipeline for like the foreseeable future. They had a lot of stuff coming off. We'll see. I think it's okay. It's already made a big recovery. So from 75 in mid 2025, it's now back up 50%. So you have to understand that piece first and foremost right here. This is a nice to hold. I think around 100 is probably going to be better. That's just my gut. But I will check it right now. Yeah, around $100 would be a solid pullback right in this area. And it's possible you see 90s, but that's if it's below. It's below the 20. It's sitting on the 50. You lose this, you're probably going to see sub 100. I don't like it. I'm just looking at a broken trend here. So even if this, from a chart perspective, one, it's already at upside targets. Two, if this was the prevailing uptrend or like the channel, if you will, it's lost trend. I mean, it's a super high risk to take Merck long because otherwise it looks like this is the general trajectory. Lilly backtest. Yeah, also not looking good. Well, this is really, so Lilly had all our upside targets achieved from the other day or from way back when, from this breakout area here, consolidation breakout. This had actually hit here. Target 11 and change. We had that outlined like months ago. Now we get a period of rest. This is wild. So this chart looks really bad. I mean, near term bad. Like you see sub 900 again. This is a pretty textbook short. Not going to lie. Short-term short into the 850s. That's a pretty textbook distributionary situation where it's like very heavy, long sideways action, kind of like circular top, and then now breaking below, retesting. Yeah, that looks pretty clean. And you have a pretty, I have a pretty heavy like volume profile that's telling me the trading ranges from 1,000 to just under 9, that where velocity will actually increase. So careful. Lilly. Is Novo selling Wegovy on HIMS like bearish Lilly? Is that really even a thing? Is that even possible? I don't know. Yeah. Patience. Nebius. You guys, a lot of people asking for Nebius. Look. If you like Nebius, I think it's worth a very small allocation. It's high risk. Still not texting my boy. I'll text him sub 60. But this is in the data center realm. It's not in the US. It's not like US build out. So I like it for those reasons. I have a lot of US energy stuff. This is not energy. This is like a neo cloud. This is sideways. So I think you do sell, I don't know, $70 puts and $100+ calls all day long on this and just sit there and plump up with all those premiums you're going to collect because it's probably going to be massive. Is Discord down? No, that was probably older. Will you get married? I don't know. So we did Broadcom. I mean, we can look at Applovin. This is in that software sector. So it's holding up. You got a big bounce and you're right into resistance now. I don't know. I think if you wait for a pullback and it holds this like low 400s, you're probably okay. Probably. But this is chasing here for sure. Palantir. It's a special stock because it's got the defensive stuff, but I think you're 165. Yeah, you're again, same thing. So this is what I have a hard time with IGV is because the bounce has happened and you've now bounced right into resistance. And in the meantime, I'm not seeing any like major strength in the equal weight ETF RSP. So like IGV to me looks like it's going to pull back. I mean, it's pulling back a little bit. Thankfully, it's not a big one. 147 is like that prior support and major pivot on Palantir. But I feel like this counter trend bounce, which is what it is, just below the top of that like prior 165 level, honestly, probably good enough for government work. I'd be more cautious. I'd be super cautious on this one. Maybe you can go sideways for a little while, maybe. But if you lose this, it's not going to be fun. I don't know. So we did Merck. What's up with Pepsi? I think consumer staples were down too. Yeah, look, not like I don't chart Pepsi. Too funny. Well, Pepsi's long is long gone. Surprise. Even consumer staples looking rough. This is a big bounce into resistance. I chill. It's a that $176, $10. I don't know. That's a big pullback. I'm looking at some support. It's kind of weak support, quite frankly. I don't like it. Unless you own the stock, then I think that's fine. This is nothing to write home about. You should have bought it in 130 if you wanted to buy more. It doesn't move a whole lot. So, I mean, it can't, as a trader, I can't get super interested in this. But the dollar's lower. although inflation might be going heavy. You have to look into that kind of stuff with these. Credo. Holding probably get a little bit more of a bounce. I think this next move continues a little bit of a bounce, but not much, maybe like $20, and then cautious. Bloom Energy, pull back to support. Is its energy theme. AVAV, this is just a broken company now. I don't want nothing to do with this. No, they lost the contract. You don't put your contract up for renegotiation if you're going to keep them. So any bounce here, I personally don't like this, or like that's a structural issue. I think the question becomes who gets the SCAR contract, which I think the market said probably ASTS. It's like antennas. So that's probably why ASTS got that pop. But this is they're not getting this contract. They lost a massive one. You gotta get that a while. VRT, I hope is gonna be good. Probably energy. All-time highs. I mean, look, so the one thing that's stable and sticky is like the market is not questioning whether or not the data center build is real or the data center spend is real. That's why I like this space, not space specifically, but this area of the market. I mean, and it's energy. So like, that's where I want to be. I mean, you look at it however you want, but there's my logic, and it's pretty straightforward. AMD, 189. It's okay. You probably get a bounce, but it's not. It's a tough one. It's not that tough. Let's see. It's the first level. I will say that the real retracement, if we start talking about real retracements, is in the 150s. You want to be very cautious because you have a head and shoulders here. Here's the issue. Not head and shoulders, double top. You have a pretty clean double top here with this neckline right around 203. 227 is the prior all-time high over here. You get a bounce on AMD for a day or two that looks like this, and then you get this. That's how you get to 150. So I'm not going to touch this guy. I don't think you could pay me to trade this right now as a swing trader. It's super dangerous. Day trader, if I see this happening in like live during the market, like I'll put this on my radar from a day trading perspective. If I see this trade, I'm not going to put this on my radar from a day trading perspective for this trade. I don't think that's really that juicy. But I would be more cautious here. Really. This is really far away from the all-time high. TLT historically is not going to do anything. TLT historically is going to be a great premium seller in this environment to sell both calls and puts. It's not going over 100 or anywhere like really close to that. Like it's just going to be sideways for like till we're out of this situation. So I would happily sell $100 leaps and $80 leap puts. And I think I could collect that like for a year or more and be perfect. This is, it's been like this for a while. This has been like the characteristic of the market. We gap down and then it gets bought up during the regular session. It wasn't just today. It's been like that. I think that was the sentiment all week. Maybe a little bears exhausted, but people still holding on. Hoodie. As much as I like my hoodie, here's where I'm at. So this is a weekly chart. this was the first area, like the major area. And so to me, this is like my discount zone right in here, measuring from that absolute low, not absolute low, but from like this more recent low here, 30. This is it. But if this $70 level doesn't hold, like I just can't be bullish until we're like much lower, probably in the 40s. And until I see like real conviction strength, I can't do anything about it. And I'm just not seeing a lot of convictions. It's high beta. This is your next level of support. So if it takes a free fall, I just like short it, hedge it, whatever, while I'm owning equity and cover down here. But that's where it is. It is what it is. Absolutely hate it. Absolutely hate it. I mean, I just don't know. Semis are different than energy. I don't think that anybody wants to go out and pick like this is the one semiconductor that's going to win. Energy's catch-all. It does everything, right? And like, what is the requirement for the semis to win? I mean, energy. So why would I take that extra risk? Some things, like I said, if they're beaten down enough, Qualcomm, back to this 135. See, like this might be a little bit more interesting to me because I don't think that their number one customer, Apple, is actually that much at risk here. We should probably look at Apple. But chart's not saying to do anything here except wait. I have earnings coming in May. So maybe you get a little bounce. There might be one or two semis out there. But the broad index, it's too rough. Yeah, I think I answered this question like 100 times in here, but I absolutely think so. Someone asked about in the same breath, Corning. I like Corning, but this one has gotten very expensive too. I think it's like PE was like 70 somethings. Pullback at 119 is like the absolute lowest that I would be willing to see. If this can't hold 120s, I mean, we know where she's going. You lose 120s, you go back to the 80s or lower. But this is it. So from here to, 160, it still needs to get over 160. I think, this can go sideways for a while. But I don't want to see this guy below 120s at all, which is a little concerning. So it's TBD. It's expensive. I think you have to do your own DD on this. Very expensive. But same thing with like things like Freeport, by the way, super expensive. This is like if you think that copper is not going to go up, or if you think that the price of optical is not going to go up and Corning is not going to make money, or, because the price today, Freeport as an example, very expensive. But if copper goes up and their other inputs don't stay elevated, i.e. gas, things like that for the miners, it's going to be perfectly fine. The ones that might be oddly a bigger short right now are the gold miners because first of all, as opposed to gold itself, and I haven't said this out loud until just now, it kind of just came to me. And as opposed to gold itself, a gold miner needs to have the market do well also for the stock to do well. And for the miners, GDX being the ETF that tracks them all, for the gold miners, I love the gold miners, but this is probably the most at risk, especially for oil. Like if oil goes up, that's the gold miners' highest cost of doing business. And so if their costs go up, finally, after years of waiting for the gold miners to catch up to gold itself, the commodity, right? Which again, this is GDX. If I put GLD next to this as a comparison chart and unlock these things, gold has gone parabolic. The miners finally starting to catch up, but if the market doesn't think that, he's off the screen. If the market doesn't think that gold is going to stay at a high premium, and at the same time oil increases or stays increasingly high, that's a hard situation. And if the market as a whole does pull back, that's the worst scenario for the gold miners. So doesn't affect gold, the underlying asset, but for the miners, the companies, that's the roughest one. Amphenol, I mean, this one got hit pretty bad. I think it's at support. I don't hate this at all. I like this as a tested. If you're going to test a dip buy in this space here, I would test it in here. Or if you don't own Corning, maybe you could test it on Corning. But with the very short lease, because they're all kind of expensive. Meta, I just don't think is going to be doing a whole lot. 500 was my big level. It's going to be a while. And like, even if Meta came up with something to really get excited about, if there's other stuff going on, it's just the wrong place. Like, look at the Qs. It just really ugly. So this in turn looks risky. If it's below 590, it's gonna get uglier. I think that the dip buy was already happened, and so did the sell. So like the dip buy sub 600 and the sell 750, 740 already happened. So like if you are still holding on, you have to be very long term. You got to go back to that thing I was talking about earlier, 30%. If you buy, you can buy here now. That's fine, but only if you have over a 3-year time horizon. Because anything else, then if you're thinking it's going to go up in 6 to 9 months, I just don't think you're going to be right. And even if you are, the risk is too heavy right now. But, if you're DCAing long-term equity, not options, and you do a little bit now and you do a little bit later and then a little bit later after that, dude, and you have no intention of selling, that's how you do it. That's how you should do it. But that's it. Carvana. I have not... Carvana. No, like this. So I see some small caps being requested. Let's take a look at the index, the IWM. So the Russell 1000 January effect is long gone. That trade is over, right? The move, the seasonal move for IWM is from here to here, right here, 20%. It's okay this year, not anything to write home about. This is 244. That is that prior pivot and all-time high that IWM as an index fought with for so epically long. Now, it's a break and a retest. We have to watch this. This one got hit exceptionally hard. This can get a little bit of a bounce, but I just will have to see this chart. Not many people are talking about. It's interesting. I think you could look at it sideways, but honestly, it's a bucket of stocks that aren't that great. I don't know that this is one I want to go out and if the market does not bounce strongly, this one actually will be what I would say is going to be a look above and fail, like all the way fail back in this area. So I think that's the caution if this doesn't continue on. So this is more like a watch because this setup for someone that's not like used to the more real trends in the market, this is still risky. I have to see serious buyers, and I have to have an environment that's going to be good for IWM. And if we're not cutting rates, I don't see how this is going to work. And well, some smaller software companies are at risk. I just really don't see how this is going to work. So I hate to be that guy. I don't know. I actually kind of see that. But technically I can see where you'd want to be bullish. We have a break and like retest, but you need to have this. It's called a break and base. Base means sideways. And then if I get a sideways base and then go, that's what I need to see. But here now with this kind of momentum, if you're asking about a small cap, just know I've just kind of gone over my my sentiment. So it's a little, that goes for Ondas. I just think you're not looking at the right things. You guys are very bullish. So anybody's asking why the dip keeps getting bought, it's because of this. I'm trying to tell them I just don't think so. Saya is, this one had something else go on. It's got to be a headline of some sort. I haven't looked it up yet. I actually like this as like if you're gonna go in the barrel, I think you can get this probably close to 330s. I don't mind this at all anytime in here. So you'll probably get this. And then because of what this is, so this company is a trucking company, less than full truckload type company. But these guys ship, I think I talked about it before. These guys ship everything that the data center people are buying, like all of it. There's got to be some headline that I'm missing here. Less than truckload LTL, lower tonnage and mixed shipment trends. So 6 days ago, they're not getting like exactly that thesis that people are shipping more yet, which maybe if they're not, like this is assuming that the whole thesis of the data center generational build is real. If it's not, I guess, I could safely say that if it's not real, this one's going to get hit. And if they're kind of warning that it's not, Q1, this is on the 3rd. January and February, less than truckload data showing shipments roughly flat, but tonnage and weight per shipment down year over year. That's why. So decline 7%. I don't know if that, we'll have to see. We'll have to see. They were on a pretty good rebound. Core weave. Yeah, this one's rough. The data center stuff, the Neo Cloud specifically, and just like these are hard. So many people asking for Ondas. I don't know why. No, don't touch this, dude. This is, were you looking for a short entry? Is that what you guys are looking for? It's not a bull market. It's not a bull market. Zeta at resistance. Coke. I mean, that's interesting, but Coke will have some pretty weird. Even these guys are getting pulled back. It's a little rough. I know, I don't like China, so I don't hate China actually at all. I had no idea JD was up this much. I don't like. I haven't liked China for a long time, and then I took some trades on China. We were going through in our group coaching. One of the newer people was asking for this chart, BABA, and my first sentiment, the first thing that came out of my mouth was that CNY, Chinese New Year, was happening. And usually, if you didn't know, Chinese New Year is actually like a sell the news event. It's a rally into, but typically a sell the news event like during and after. It doesn't really hold. So when I look at something like this, BABA had, and we'll look at JD in a second, big old base and rally back up to this, by the way, is a bearish retracement. So I'm always trying to be a good bull. And so I need to know where the bears are sitting. 190, I had 190 up to 219. We were in this trade. I was in this trade. Here we are pulling back. The pullback of this, by the way, is just this more recent dip. I need to see this over 133 from a technical perspective. And if it doesn't, then I think a dip in this area, by the way, you have earnings here in a little bit. This is a better, from a long-term perspective, base, break, and then if we get a base and then another break, that's how we get there. This is long, this is a weekly chart. Chinese equities do not trade off of PE or Western metrics. It's just not how they work. So if you're thinking about it like, oh, it's cheap, I think you're probably doing it wrong because it was cheap for a very long time. What they do trade off of or move off of is like the policy. And so like if the CCP is like very like pro like private companies, we want these companies to do well, and the policy supports that, that's what's going to matter. And that shift in policy here is when we got this. So wartime, I don't know. Nobody's been disappeared for a long time. I think it's probably better. And if there is a war, I would actually say it's probably better. JD specifically, though, that's Chinese like retail. It is in the dip, but it's been in the dip for a minute. This is a hard low. This was just so ugly, ugly chart. There was always a thought to JD that, hey, look, I think Singles Day was actually a lot better than it could have been. This is probably just maybe not supposed to be up there. And so here we are back in this low. I don't mind this actually at all. I don't mind this. You're probably coming up to the 20. If you have a stop around that 24, which is how we would do this, if this was the actual low, then I'm going to look for the low before that low. I'll just say right here, this is what I would call like something called a price of interest. So $24 is great. The thing about this one is that what is the upside? I'm not really sure. Like I can't, it's not going to 60. Where is the sentiment behind this? I don't know. Could it go to 36? Yeah, I actually think this could go to 36. So, 20% from here is probably potential. But you'd have to risk down to 23 at the same time. So it's a 1-to-1 risk to reward. I would love to see it. This death cross thing is just so hilarious. Like Palantir, do you guys notice this? My hoodie, Palantir, probably SoFi. Nobody asked for SoFi today. Palantir Death Cross. There she is, 136. Now you come up and you bounce the Death Cross. It's like a heads up. We don't know that we're gonna continue upside. That's sentiment, right? Market sentiment. A lot of market sentiment doing. SoFi, I believe, got the Death Cross the other day. Look at it. So I would be more inclined to go long SoFi right here, right now, than a lot of things just for a trade, like just a trade. I could be absolutely wrong, but just on a mean reversion perspective, even though this is not at my levels, I mean, this is an order block, we would call it, break a structure here from this prior high, a little pivot here. If I pull this down, I mean, it's a small one. It's not anything to write home about. But just saying, I actually would be more inclined to go long SoFi right here, right now than a lot of other things. As weird as that sounds, I haven't looked at Verizon. This thing is having a wild year. Let's see if it's come down and all. No, it's sideways. I do think it's died, and let me show you why. So I got to go out to a monthly chart on Verizon, and yeah, it's had a great year, but it is right back into tactical kind of resistance right in here. That's a monthly. Here's a daily, and I'll turn on my volume profile and see where we can see. So in this area, if it can hold 49, that's great. But if it's below 49, that's a bigger deal. Speaking of these kind of names, have anybody looked at, I think it's Versant. This stock I bought like randomly, didn't really think much of it. I could probably sell it now. Actually, 2 days down. Never mind. Take it back. Don't look at this one anymore. It's probably done. AOI. I'm going to skip. I don't even know what that is. SCCO, silver, copper miners. I think that the copper miners have been beat up the most, but it's so tough. I feel like energy is the easiest one. It's not an easy trading environment. I'd rather a copper miner over a gold miner right now. I'd rather a silver miner over a gold miner right now, truth be told. But these can all be very, very expensive. Merck was losing Keytruda in 2008 and ACA. Okay, so there you go. Probably not great for Merck. I wouldn't buy. Yeah. So Kevin, yeah, AstraZeneca is interesting. I haven't looked at this chart in a while. This is all about pipelines, things like that. And then if you miss the if you miss the godlike chart, Novo Nordisk. So shout out Kevin. Novartis, not Novo Nordisk. I feel like everybody kept typoing the S, the O, like NVO. They thought it was NVO, but they should have been looking at NBS the whole time because that's the chart. SLB, I actually like, so Slob got beat up. Again, these are more in like, they're a little bit expensive. These are expensive right now. So it's come up a lot from the lows. Did this do a split or something? I don't remember this ever being, that's 2020. I don't remember being 12. $30 to near 60 off the lows. So expect a little bit of a pullback. These are the kind of things that like, this is energy services, servicing the energy sector, not energy themselves. They don't produce oil or anything like that. So like on pullbacks, I will like these a lot more. So like, I think that this is one I'm happy here. I own this stock. I'll buy it again if I see it at like sub 40s, but I have to acknowledge, hey, look, it's a little hot. It's coming into pretty heavy resistance, technically speaking. And, some of the markets like, look, it's not going to, last. I don't know that it's not going to last, but pullbacks here on something like this, or even my Oxy would be probably, there's no pullback on Oxy. Where's my Oxy pullback? Come on, guys. I'm probably going to get an Oxy pullback. This is right into resistance. So like, I think, even nat gas. So we talk VG. In the U.S., natural gas is not that expensive and has not gone up that much. Look, VG back to the highs. Globally, it is way high. But Oxy and VG both are at my upside targets for now. So I have to expect sideways price action to maybe some choppiness. And if I get a dip that's more in line of like what you're seeing at maybe SLB, maybe something to 50s, I like adding down there. And if this does, from a higher time frame perspective, if this does start to like fix itself from a chart perspective, guys, this is not looking bad at all. So when it comes to energy and things like this, I do like these areas. I know it's not what you're used to, but for the next 3 to 5 years, I would challenge the thought that they won't challenge the returns of some of these software names. SanDisk. What's happened to Rivian? My Rivi was up today. Look at this. Rivian to the moon. You put this on a monthly chart, it just looks so sad. But yeah, I don't think this is going anywhere right now. I think you're as close to 14 or below 14 anytime this is 14. I nibble. I think it's a transition year, but 2028, 2027, 2028 would probably be better. That's when we're going to see. Do they last? I still think they have a ways to go, but I don't think they're going bankrupt at all. SanDisk, little bouncy bounce into resistance. I would wait. There's a lot of stuff here that's waiting. Why people want sock sell so much, I don't know. Does the chart have beauty? It depends on how you look at it. Ulta lost the 20. Where's my 50? And the 50. I think she does from a long-term time perspective. I don't know. You tell me. I like it. This is a turnaround story, though, also, by the way. Like, they had stores and Targets and stuff like that. They ripped them out. They did their own kind of thing. I think this will continue, but buyable dip sub 600. I like it. I like it for the year. Plus, it has like that defensive kind of setup. So as long as Ulta holds this year well over 615 for the majority of the year, we should be good. Otherwise, if it does not, then I can expect a pullback into the 450s. It's a little early for me to say. They have earnings coming up pretty soon. So right now, this is retesting last year's high. This is a retest of the annual candle break retest. I'm not moving. I'm not going anywhere. Here are the risks. I'm not touching this thing. I love it. ASML. Yeah, I mean, these look good, but like they haven't had a whole lot of pullbacks. Tough. I like KLA. I like KLA better. Oracle. You guys, Oracle be rough. Boeing, and I'm going to cut this in. I'm trying to get through a bunch here. Boeing, I think, is a turnaround play. It's not so much massive potential China orders. That's been coming for a long time. I just don't think that was going to really make the stock move. But in this general area, if you like Boeing as a longer term turnaround trade or positioning, I like it. It's not short term though. Let's see. Tesla to 340. but it's not holding. But it's not breaking either. So a lot of these are kind of like downside here. I feel like it's more of like a wait and see. This is too small market cap for me to play with. I'm sure of it. Yeah, I can't even talk about this one, guys. I think if you're such a small player in a real big industry, I don't think it's very real. It's very niche. CLS. And we'll end on NVIDIA. Celestica. I mean, that's a retest of support. Let's see how well it holds. I like this area, but high beta, if you like it, you like it. That's a break retest. I think you're most of your downside's done, but you don't want to see this any lower. This is like my GLW right here. No, so NVIDIA, I feel like was at the lower end of the support box right here, near term lower end. So this one has, as opposed to the rest, they have GTC coming up next week. We'll see. It's been a bumpy ride for, I don't know what you call people that work at NVIDIA or NVIDIANs. I don't even know what to call them. This is support. You'd like to see this. So 193 is resistance in the 190 area. This is the box that NVIDIA has kind of been living in right here. So if it holds and you get a shot at the bottom of the box, which is like mid 170s, to go back up to the 190s, I think that's the tradable range. You're kind of near that midpoint right now. So I would just kind of wait and see if you didn't grab it out of the gate. I don't know that this is going to break down with their event so close, like so much around the corner. Again, 290s on Legoogs. I mean, it's breakdown, but it's instantly bought up. There's nothing in Google's situation here that's at risk for me. So it's like, that's probably why it's going to hold relatively strong. But that was a breach. This kind of trappy price action. I'd be a little more concerned there. Microsoft, mega cap. Again, I want it. I think this is fine, but my downside is lower. This is right in that weird spot for IGV. Rough. It's a watch. The sentiment for the market is not in a place to think that you're going to have a V-shaped recovery. Not right now. At least as of this moment today. If something changes, cool, something changes. If you guys know something that I don't know that would change the whole sentiment of the market, that's fine. But like, I know what's real in terms of what is out there and what I'm seeing. And it's like, you read the room. I'm reading the room of the market. It is what it is. And it's just not, they're decent discounts, but they can get better. And I'm a greedy bastard sometimes, and I really like my deep discounts. So I'll go Black Friday shopping with you guys all day long, but we're a little ways away from that. Until then, I think some things are tradable bounces. I will say that. And I think that's kind of where I'm going to leave it off. So I like a lot of things. Not everything bottoms at once, but when the bottom falls out, they typically do. I just don't see that happening either. It's just kind of like headlines got people on edge. We get a ceasefire headline and all good in the Middle East, and we will rally back again. Two charts that I think are most important, IGV and RSP. If they're both trending in the same direction, I think it's all good, and those will tell you what direction. In the meantime, if they're going in separate directions, it's probably a little bit choppy. So until then, I think we have to just kind of like stay the course, be patient. Patience pays, and I'll see you guys on the next one. Adios.